Good afternoon from Bangkok and welcome to Minor International First Quarter 2019. Today we have a pleasure to introduce our presentation in which you will hear from Mr. Chayapat Paitun, our Deputy Corporate CFO, and Mr. Tatip Adunpan, Vice President of Investor Relations. The aim of today's presentation is to update you on the first quarter performance as well as introduce you to our strategic direction and business outlook for the remainder of the year. Now I would like to hand over to Mr. Chayapat and Khun Tatip for the presentation.
Good afternoon. So we'll start off again as usual with the first quarter results recap, followed by the performance of each business unit. Start off with Minor Hotels, followed by Minor Food, Minor Lifestyle, and end with the corporate information and 5-year strategy. On the performance recap, in the first quarter of this year, we reported revenue of about 29 billion baht, about 79% increase compared to last year. In terms of net profit, it's about 633 million baht, or down by about 63%. However, because this year we have the consolidation of NH Hotel Group, whereas last year we didn't have the consolidation, so the comparison may not be very meaningful. Anyway, with NH performance doing very well in the first quarter, we continue to be confident in the delivery of our full year performance. In order to make the comparison more meaningful, we have actually done a like-for-like exercise where we've simulated as if we've consolidated NH in the first quarter of last year as well, compared to the first quarter of this year. So if you look at on a like-for-like basis, revenue actually increased by about 2%, excluding the foreign exchange impact. And if you look at in terms of net profit, it's actually up by about 20%. If you look at the graph, you can see that in terms of just organic mint pre-NH, we actually saw net profit decline of about 8%. But because NH's net profit actually improved by about 37% compared to the same period last year, that's why we saw the net profit growth of about 20%. This is pre-financing and acquisition related expenses. In terms of international presence, so for the whole portfolio today, about 69% of the revenue is from international, while 31% is from Thailand. So that's on trend for us as we expect the revenue from international to contribute a bit more over the next 5 years to about 72% in 2023. And today we operate in 63 countries. Now going into a little bit of the more detail for Minor Hotels. For Minor Hotels, we actually saw revenue growth of about 138%, EBITDA growth of 37%, and net profit decline of about 89% year on year. But then again, if you look at the graph on the right-hand side, it's primarily because of the consolidation impact. So it might not be very meaningful to look at this overall comparison. It's just more of a new base for us in terms of the seasonality on the quarterly basis going forward. So we'll just do kind of like Minor Hotels excluding NH just to look at the organic performance, and then we'll talk a bit about the NH performance by itself. So if you look at in terms of revenue, this is excluding any non-recurring items and also excluding NH's performance. Revenue is down by 3%. That's primarily because of the management letting rights business unit and also the Anantra Vacation Club. if you look at in total of minor hotels, the owned hotels contribute about 26% of minor hotels. Revenue actually grew by about 1%, and that's primarily from our hotels outside of Thailand. So primarily Portugal, Maldives, and Africa, which did well, and that actually was offset by the slowdown of the hotels in Thailand. For management letting rights, which is today about 6% of minor hotels revenue, revenue in Thai baht term actually declined by about 18%. Primarily, there are two reasons for that. One is the RevPAR in Aussie dollar term declined by about 5%. That's primarily because of the pressure on the room rate. And also, we got the double impact from the weakening of the Aussie dollar, which declined by about 9% compared to Thai baht in the first quarter of this year. Management contracts today contribute about 2% of minor hotels revenue. Revenue from management contracts increased by about 14%, and that's primarily from UAE and the Maldives. And also we have additional revenue contribution from the newly opened hotels as well. Mixed-use business for the first quarter contributed about 6% of the revenues, and that actually declined by about 4%. So primarily it's because of the sales of the Anantra Vacation Club, which we did sell some of the residential development during the quarter, but it wasn't enough to offset the decline of the Anantra Vacation Club. So with that, portfolio, all in all, revenues down 3%, as I said earlier. EBITDA and net profits down a little bit more, 4% for EBITDA and 5% for net profit, and that's primarily because of the lower flow through of the management letting rights from the lower ADR and also from lower flow through of Anantra Vacation Club as well. Going into NH hotels, for NH hotels, they actually reported revenue increase of about 4%. So that's primarily because of the RevPAR increase, which was up by about 4.2%, both from occupancy, but a bit more from the ADR. And the regions that have been doing well are Spain and Central Europe in the first quarter of this year. Because of the cost control and also because of the revenue increase primarily from the ADR, so they get a little bit more flow through. They actually saw EBITDA growth of about 33%, which means the margin increased by about 1.3%. And the EBITDA conversion rate is about 42%. Going down to the recurring net loss, they actually saw net loss improve of about 8 million euros. That's primarily from business improvement from the in RevPAR and also in the EBITDA margin. And also they had lower financing costs because they've redeemed some of the convertible bonds since June of last year, and also partial early redemption of their bonds in December. For reported net profit, last year they had gain from asset sale, which is pretty much the hotel in Amsterdam, which they got gain of about 55 million baht. So last year they actually reported gain of 22 million euros. But this year, because the sales asset rotation activities came back to more like normal level, so net loss, they reported net loss of about 12 million euros. But with the performance, it's actually as expected. So they're still confident of the full year guidance of EBITDA of about 285 million euros of EBITDA and 100 million euros of net profit. And they also reported announced dividend of 15 cents per share, which is about 47% payout ratio. Now, once you we convert that into Thai baht consolidation, revenue is roughly the same. In terms of EBITDA, in Thai baht equivalent in the dark green chart, it's a little bit more than NH's reported number when it's on our balance on our P&L. So the 189 million baht that is a little bit more on our P&L is because of some accounting standard differences between NH and Mint. And also, in terms of net profit, we also, in addition to the net loss this quarter, we also had the acquisition-related expenses of another 462 million baht. That's primarily from two things. One is the interest cost from the funding of this acquisition, and also depreciation expense that that's from when we mark up the fair value adjustment of our assets. In terms of international presence, so today we are 83% on the hotel side outside of Thailand and 17% revenues coming from Thailand, which is in line with our plan to bring revenue from Thailand down to about 11% over the next 5 years. And today we operate in 54 countries on the hotel side. Just turning a little bit to the stats on the system-wide hotel portfolio. Of course, we saw number of rooms increase by about almost 3 times. So that's primarily from the from the acquisition of NH. In terms of RevPAR organic excluding FX, it's down by about 1%. So that's primarily from Thailand, slowdown of the Thailand RevPAR and also the management letting rights, which was a little bit offset by the good performance of the overseas portfolio and managed hotels. If you look at system-wide RevPAR, it's down 37%. That's primarily from the consolidation of an NH portfolio, which they have lower RevPAR compared to ours. Going into owned and leased hotels, which is today about 85% of minor hotels revenues. So again, in terms of number of room, it's up primarily because of the consolidation of NH. In terms of organic RevPAR excluding FX, it's down by about 2%. So that's primarily from hotels in Thailand. And then system-wide is down by about 44% because of the consolidation of NH. If you look at in terms of revenue, it's actually up by more than 3 times, primarily because of the consolidation of NH. For the owned hotels in Thailand, if you go into just the owned hotels, today 15% of the revenues from Thailand, overseas 15%, and NH is 70% in terms of top line. Going into Thailand, it still remains the biggest contributor in terms of single country. And if you look at Thailand RevPAR, it's actually down by about 6% in the first quarter of the year. As you can see from the graphs, Bangkok is down 2% and provinces is down by about 9%. So that's and the decline is primarily from the continued soft Chinese tourists, although it's getting better. So if you look at last year in the third quarter, Chinese was down for us in our Thailand portfolio. Chinese was down by about 15%. Fourth quarter they're down by about 5%, and this quarter, the first quarter, they're down by 2%. So gradually the situation is improving. In terms of Bangkok hotels, so the RevPAR declines primarily from lower ADR as we were more pressured by the competition with the softer traffic, tourist traffic coming in. And the provinces, it's down by 9% pretty much across the region. But going into this quarter, in the second quarter, we're starting to see improvement. So in terms of total RevPAR for Thailand, it's actually slightly up by about low single digit, and the driver is primarily hotels in Bangkok, which is up in high single digit, while the province is still slightly down, low single digit down for RevPAR for the quarter to date. For owned hotels outside of Thailand, but excluding NH, so our organic hotel overseas hotels performance, RevPAR in Thai baht terms down by 3%, but it's primarily because of the strengthening of the Thai baht against many of the currencies that we operate in. So if you look at organic RevPAR excluding FX impact, the portfolio is actually up by about 6%, and it's driven primarily by pretty much all of our major markets. If you look at Portugal is flat in Thai baht term, but in euro term, it's up by about 8%. Because first quarter is low season for Portugal, the RevPAR growth was primarily from occupancy. For Brazil, in Thai baht term, it's down by 3%. But if you look at in local currency, it's actually up by 13%. So Brazilian real actually saw over 20% decline first quarter of this year compared to last year. So organically or in local currency term, they're doing very well, and both hotels, both in Sao Paulo and also the beach destination, both are doing well. RevPAR in the Maldives was flat, both in Thai baht and US dollar term. We did increase the rate slightly, but that also resulted in a slight slowdown in occupancy or traffic. So that's why the RevPAR overall is about flat. In Africa, RevPAR is up 7% in Thai baht term. In local currency, it's up 28%. So all hotels are doing well, especially in Namibia and Zambia, where we actually saw RevPAR growth of 30% or over in the local currencies. Going into second quarter of the year, quarter to date number, we're still seeing good RevPAR growth, so still high single digit, and pretty much it's driven by all of the markets, whether it's Portugal, Brazil, Maldives, or Africa. They're all seeing positive RevPAR growth in Thai baht term. For NH Hotel, their RevPAR is up by about 4%. And it's driven by pretty much by all of their key markets as well. The highlights are, of course, Spain and Central Europe, as mentioned earlier. So in Spain, both Madrid performed well. Both Madrid and Barcelona performed well. So Madrid actually saw very good trade fair activities, whereas Barcelona saw recovery since the fourth quarter of last year from their political situation. In Italy, RevPAR was up by about almost 1%. Rome did well, whereas Milan actually saw lesser trade fair activities during the quarter. Benelux up by about a little bit over 1%. So we continue to see good performance in Brussels and also in Amsterdam. The only a little bit of pullback was from the Congress Center hotels because less corporate events during the quarter, but we should see recovery in the following quarters. For Central Europe, Munich and Vienna were the two main cities that drove the RevPAR growth with the trade fair activities. And Latin America was up 5% in euro term. In local currencies, it's actually up higher at about 18%. And it's driven primarily by hotels in Argentina, Colombia, and Chile. Just a little bit on the NH integration. So we've actually identified, actually since before, we've actually identified the 5 main categories, whether it's enhanced customer base through cross-selling, loyalty program, or economies of scales, which we should get better costs, whether it's with distribution partners and OTAs or with the suppliers. We continue to look at cross-expansion, whether it's growth in Anantaras in Europe or NH in this part of the world. We're looking at rebranding opportunities and new openings. One of the example is we already have one hotel, leased hotel that will be an Anantara in Spain that will be opened or rebranded sometime this year. And Tivoli integration is also in process. And of course, we're looking at talent mobilizing of talents across the groups. So that's something that's already ongoing. NH has already done the 5-year plan and including the integration initiatives, but we're waiting for the board approval, and the plan will be announced after that. NH has come out and said that probably sometime after summer, which is about September, that's when we'll announce the new 5-year plan with more numbers. Turning back to the operation, so management letting rights or OAKS, which is about 6% of minor hotels revenue today. As I mentioned earlier, OAKS actually saw some pressure on the RevPAR in Aussie dollar term. It was down by about 5%, primarily from rate decline, and because of the economic slowdown in Australia. So they've seen some impact on the demand, which also put pressure on the rate side. With that, coupled with the weakening of Aussie dollar, revenue was actually down by about 18% in Thai baht term for OAKS, and because of the lower ADR, they also had some pressure on the margin as well. For managed hotels, which is today about 2% of total minor hotels revenue, of course, number of rooms increased because of NH acquisition. In terms of organic RevPAR, it's actually up by about 3%. So the countries that are doing well are UAE, Oman, Seychelles, and Indonesia. But of course, system-wide RevPAR is down 31% because of the consolidation of the NH hotel. But revenue of managed hotels increased by about 14% in the first quarter. So that's primarily from hotels in the UAE and the Maldives. And also because we've added more rooms over the past 12 months as well. This is the hotel expansion pipeline. So over the next 4 to 5 years, we're expecting to open about 18 hotels that are owned or joint venture, and another 63% under management contract. And as I said earlier, there is one hotel under Anantara called Marbella in Spain. So this one would be leased hotel, will be the first Anantara under the NH portfolio. This is just the minimum, as we've always said. So anything on top of this, as we sign more new contracts or as we acquire more hotels, so there can be an upside to the numbers here. Turning to mixed-use business, which is about 6% of minor hotels revenues. So the projects, the current projects and the project in the pipeline are pretty much the same as what we've announced before. In the first quarter of this year, we've actually had some selling activities of the residential development project as well. And the last business on the hotel business is Anantara Vacation Club. So Anantara Vacation Club actually saw a number of members increase by about 18%. So we now have over 12,000 members. But in terms of revenue, it's actually down by about 14% in the first quarter of this year compared to last year. And that's primarily because we put in price increase in about December of last year. But at the same time, at that time, Chinese economy also started to slow down. So we were temporarily impacted. So the number of points sold were a bit lower than last year. So because of that, Anantara Vacation Club revenue was down by about 14%. But we feel that this is going to be temporary. As people get a little bit more used to the price increase, we should start to see the revenue starting to come back. And now I'd like to turn to Kun Chayapat for minor food.
Yes, for performance of minor food, revenue in the first quarter increased by 5%, mainly due to the expansion of our restaurants, which continue pretty much in Thailand and China. This is, however, not it's slowed down by the negative same-store sales growth, which still happened across the board with the exception of China on the back of the weak macro backdrop. And if you look at EBITDA and net profit, EBITDA declined by 2%, while net profit declined by 13%. Even though China profitability improving, but it's not sufficient to compensate for margin pressure that happened elsewhere, especially in Thailand, where we see contraction of same-store sales, and we also had a spending on the promotional campaigns to drive traffic in Thailand. If you look at total system sales, we show growth of 5.3% in the first quarter, pretty much because of the outlet expansion. The brand like the Pizza Company, Burger King, Dairy Queen, the Coffee Club, and Riverside reported positive total system sales growth on the back of their outlet expansion. So if you look at outlet expansion, like I said, we still continue to see about 8% growth year on year as a result of those brands that I just mentioned, as well as Benihana, which we acquired in April 2018 as well. But for same-store sales, even though same-store sales of China turned positive, but elsewhere like Thailand and Australia still see challenging macro backdrop. So we still continue to see negative same-store sales in Thailand and Australia. So we will continue to strengthen our multi-brand portfolio, come up with product innovation, the proactive marketing and promotional campaigns to turn the performance around going forward. Next slide, just to show you that we currently operate in 27 countries across the region, and contribution from international came in at about 35% of total minor food revenue in the first quarter of the year, while the remaining 65% still coming from Thailand. Now let's look at the stats. I talked a little bit about it earlier. If you look at this, the chart, total system sales grew by 5.3%, mainly on the back of outlet, 8% growth in outlets, primarily from China, China and Thailand, and developing hubs, which saw outlet expand. But elsewhere, same-store sales, still seeing negative, it's still in negative territory. So overall, same-store sales in the first quarter came in at negative 4%. Thailand and Australia still facing some challenging macro backdrop, as I said. So I'm going to go into hub by hub briefly. For Thailand, same-store sales declined by 6% in the first quarter. Consumer confidence still fragile during the quarter, and we see the stats in upcountry lag behind the stats in Bangkok as a result of lower farm income in the first quarter, and also in Bangkok still show some negative number as a result of higher competition, as well as some disruption from delivery operators as well. For total systems sales, Thailand hub still expanding their network. So in the first quarter, total system sales is in a slight positive at around 0.5%. So the strategies for the remainder of 2019, we would try to increase customer accessibility, convenience for consumers to get our products and services through both physical and digital channels. And we also try to come up with new menu items, product innovations to ensure that brands still relevant to a new generation of consumers. And we also overhaul our digital technology platform, including operations, customer service, loyalty program, e-payment, and also data analytics to get more and better insights about consumers, so we can satisfy and anticipate their needs better. Moving on to China hub, China, it's a highlight and standout among all the hubs that we have during this quarter. It's remained one of our key growth driver. same-store sales turned positive at 2.5% in the first quarter as the outlet restructuring or rationalization program that we did earlier in the prior years start to pay off. Total system sales as well also came in at around 22% on the back of both positive same-store sales growth and also rapid outlet expansion of about 17% during the quarter. So the strategy of China Hub is just to focus on Riverside brand, which is the barbecue Sichuan style grilled fish that we want to shift our focus onto the cities like Beijing and Shanghai and the surrounding area. And also we're trying to improve customer experience as well as the highlight our food traceability programs because food safety and food traceability is very important and paid, Chinese consumer paid a lot of attention to these two issues. We also going to beef up further our CRM platform to increase our sales in China as well. For Australia Hub, as I said, revenue in Thai baht term, although declined by 3%, but that was because of the weakening of the Aussie dollars. If you look at Aussie dollars revenue, it's increased year on year in the first quarter. However, the challenging macro backdrop in Australia still makes same-store sales growth in a negative territory of 2.1% in the first quarter. And total system sales, even though still remain in the negative territory of 2.7, but it's improved much better than the previous quarters. And the reason why total system sales was in negative territory over the past few quarters was as a result of the rationalization or the closure of some of the loss-making stores, as well as some of the one of our brand divestment make it total system sales coming down. For the strategies for the remainder of 2019 for Australia Hub, we try to uplift our store and also the convenience through delivery channel for our consumers, and also come up with more hero products or highlight menus to attract people to our store, as well as to increase our international expansion further. Especially, we have been successful in expanding the coffee club outside of Australia, mainly in Thailand. And we're going to do more vertical integration by expand coffee roasting business to sales coffee beans to retail channel, like at the coffee club store itself, or even do white label business, as well as doing wholesale through supermarket channel as well. Moving on to Minor Lifestyle. Minor Lifestyle revenue increased by 11%, driven by both retail trading and contract manufacturing. For retail trading, revenue increased by 10% as a result of Charles & Keith, Anelo, OVS, Bossini, Henckels, and Joseph & Joseph, together with the new brands that we added onto our portfolio, which are Bodum and Save My Bag. For contract manufacturing, revenue increased by about 13%. We continue to sales to our existing clients. At the same time, our business development team also pursue more new clients, and we get more sales from our new clients as well. For EBITDA rose by 17% on the back of higher revenue and on the back of our cost-saving methods like rental expenses and some of the personal expenses. But net profit increased by a slower rate because of a higher interest on the back of the business expansions and pre-opening expenses for some of our new brands. Then let's look at the Capex and balance sheet strength overall. This is similar to what we reported in the previous quarter. We still committed to bring our leverage ratio down. In the first at the end of the first quarter, our debt to equity ratio stood at 1.54, and we're still on track to bring it down to 1.3 by the end of the year on the back of profit contribution that we're going to have, as well as some of the asset sales program that we are in the process of doing right now. So still on track in terms of Capex plans, still the same number. In the next 5 years, we set aside about 64 billion baht to expand our businesses that we have or any pipeline that we have signed as reported by Jutatip earlier on. Let me update you a little bit about our funding plan and the term out program that we had on NH acquisition or NH investment. If you remember last year we acquired NH, we spent about 88 billion baht using bridging facilities, which is a short-term facilities. And since then we're in the process of doing term out programs through issuings or borrowing longer term debts to replace the bridging facilities. We have done Thai baht perpetual bonds. We have done US dollar perpetual bonds already. We did forex bonds. We issue Thai baht bond in this first quarter as well. We issue about 33 billion baht Thai baht bond in the first quarter, of which 24 billion was used to refinance this bridging facility associated with an NH acquisition. So roughly, we still have a little bit left to refinance. That will be done through syndicated loans and also some bilateral loans, as well as we expect some of the proceeds from sales of our hotel assets that I just mentioned to also reduce or replace the bridging facilities, refinance the bridging facilities that we had. Last section was on 5-year plan. It didn't change much from what I've already shared with you in the previous quarter. Just want to highlight the goal or objectives. We want to see revenue growth of higher than 10% per annum on a CAGR basis over the next 5 years, with net profit growth at a higher rate since we expect to increase margins and profitability. So NPAT growth will hover around 15 to 20% per annum on a CAGR basis with ROIC of 12%. The strategy is to use winning brand portfolio, increase profitability and value, increase value capture, productivity, looking to do the right opportunity to invest or partner with strategic partners, overhaul and beef up our digital innovation platform, empower our people, as well as maintain sustainable framework alongside our business strategy. So that's pretty much our presentation for this quarter. Now we're going to answer some of the questions that has been sent online here before we wrap up. The question is, how is the performance of the hotels in Thailand in the second quarter?
So hotels in the second quarter, as I said earlier, we were seeing improvement. So in terms of RevPAR, it's back to positive territory. So we're seeing RevPAR growth. For the overall portfolio, is in the low single digit, and it's driven primarily by hotels in Bangkok. So hotels outside of Bangkok, we're still seeing slight decline in RevPAR, but overall for the whole portfolio, it's still up low single digit. Number 2 is with the positive same-store sales growth in China that we saw in Q1 being maintained going forward.
We will wait and see to see the results or the number in the second quarter first, but we'll try the best we can to make it sustain. As you know that we have shifted our focus in China to focus more on Beijing and Shanghai and the surrounding areas, and we already closed some of the outlets in tier 3 cities of China, which produced negative same-store sales for us earlier. So let's wait and see in the second quarter and the remainder of the year to see whether it will sustain. Number 3, What is company's cost of debt currently? In the first quarter of the year, average interest rate stood at about 2.9%, roughly. So, yeah, still below 3% on average. Next questions is about do we have plan to sell any assets? Yes, as I mentioned earlier, we are in the process of selling some of our hotel assets, but we don't just sell assets outright. We plan to sell and lease it back to operate under our brand, so we still maintain our brand awareness among consumers with that assets. But at the same time, we still have proceeds from sales to reduce our debt. Mixed-use Silom project, whereabout on Silom? It's in Convent Road. Any plan to do more debentures? Well, not in the near term. As I said, we just successfully issued debenture in March of this year, almost 3 times oversubscribed. But like I said, our program of NH pretty much almost done. So not in the near term. If there's any progress, I will come update again. The Capex for the next 5 years, as I said, it's around 64 billion baht, and that will come from like the profit generating capability of the company, especially with the contribution from NH that coming in, as well as the asset sales that I talked about earlier. How do we see the outlook in Thailand and outside of Thailand? Well, we still see Thailand is still a favorite tourist destination for travelers around the world. So Thai hotels prospect in Thailand still quite promising, and overseas, as Khun Chuthakip just said, the outlook for second quarter looks good for major markets outside Thailand that we have, especially in Europe, like the big operation that we have outside Thailand through NH. NH has a good hotel in the primest location in the middle of the gateway cities in Europe. So it's really hard to have any new supply, or they have a very good asset which is hard to replicate, and demand still coming in from all over the world. So prospect for hotel business outside of Thailand still looks promising as well. For food, it's still quite challenging for Thailand, so we still have to work on our turnaround strategy, and we hope that we can get it back up on track within this year.
The other thing is also NH going into second quarter starts to be their high season. So they're quite confident in the business outlook going forward for the rest of the year. So NH will also be another driver for us going forward from second quarter.
Okay, wait, maybe very last questions. So why did we decide to sell our JV stake in Bread Talk in Thailand? Well, it's a pretty small operation in Thailand, and the partner want to also do it themselves, as well as we also still being able to enjoy any profit contribution from Bread Talk, either in Thailand or elsewhere through our shareholding in listed Bread Talk in Singapore. So that's more like a strategic decision direction that we want to do it via Bread Talk Singapore instead of doing ourselves in Thailand. So that's a wrap, I guess.
So that's the end of all the questions that we have. Thank you for your participation, and if you have any more questions, please do not hesitate to contact the IR department. Thank you.